The group chat is called Money Moves. There are 11 people in it. It was created in 2020 during a period when everyone you knew was making money in the market, and the market felt, briefly, like something that had changed its fundamental nature and become a place where normal people got rich quickly, and the only question was, which vehicle to use. The chat is still active. It is quieter now. The people in it have learned, at varying costs and varying speeds, the specific lesson that the market teaches. People who arrive believing it has changed its nature. It has not. It never does. You are 37. You make $86,000. You have $22,000 in a 401k and $6,400 in savings, and a brokerage account with $3,100 in it that once held $41,000. The distance between $41,000 and $3,100 is the story. Not a story of bad luck, not a story of a rigged system. A story of a very human and very expensive tendency to confuse the feeling of being early with the reality of being right. 2020, the beginning. The stimulus check is $1,200. You put $800 of it into the market on a Thursday in April, not into an index fund, into 3 individual stocks you had researched across 2 evenings of YouTube and Reddit, and a podcast you found through an ad on another podcast. The stocks are real companies with real revenues. The research felt substantive. The position felt considered. By August, the $800 is $1,940. You have more than doubled your money in 4 months on decisions you made in 2 evenings. The lesson your brain extracts from this is not the correct one. The correct lesson is that you bought into a market recovering from a crash with stimulus money and monetary policy behind it. The lesson your brain extracts is that you are good at this. You move $6,000 into the account. You spend 3 weeks learning about options. Options are not complicated in the mechanical sense. You understand calls and puts and expiration dates and strike prices within the 3 weeks. But the risk profile of options is not what 3 weeks of learning produces competence to manage. You do not know this yet. You buy calls on a company whose product you use and whose stock has been climbing for 6 months. The calls expire worthless. You lose $2,100 in 43 days. You tell yourself it was tuition. This is partly true, and partly a reframe that allows you to continue without examining the decision that preceded the loss. 2021. Crypto. The group chat finds crypto in January. Not all at once. Gradually, one person mentioning a position, another following, the social dynamic of a group watching one member's returns, producing the specific pressure of visible missed opportunity. You buy Bitcoin at $38,000. You buy Ethereum at $1,400. You feel, doing so, the mixture of excitement and anxiety that you will later recognize as the signature feeling of buying an asset because others are buying it, rather than because you understand its value. By November, Bitcoin is at $67,000. Your position is worth 4 times what you paid. The group chat is very loud. Someone has quit their job. Someone else is talking about a beach house. The mood is the mood of people who have correctly predicted something and are now indistinguishable in their own perception from people who understood something. You do not sell. This is the decision. Not a decision made from analysis, from the feeling that selling would mean leaving money on the table, that the thing going up will continue going up, that the correct move is to hold and accumulate and let the compounding run. These instincts are correct for long-duration index investing and catastrophically wrong for speculative assets at peak sentiment. By June of 2022, Bitcoin is at $19,000. Your position is worth slightly less than you paid. The group chat is quiet. The person who quit their job has returned to work. Nobody mentions the beach house. You hold. The holding is not conviction. It is the specific paralysis of someone who has watched a large gain become a small loss and cannot bring themselves to realize the loss because realizing it would make it permanent. And permanence is the thing the holding is avoiding. You hold through $12,000. You hold through $8,000. At $8,000 you sell, not from strategy, from exhaustion, from the weight of watching something fall for 14 months and needing it to stop being something you think about. The crypto loss, combined with the options that expired worthless, is $29,400. You do not calculate this precisely at the time. You calculate it later, on a Sunday, when you are looking at the brokerage account and trying to understand the distance between $41,000 and $3,100. The pattern. Named. You are not uniquely susceptible to this. The behavioral finance literature has documented what happened to you with the consistency of a physical law. Recency bias. Recent performance feels predictive in a way that long-term data does not. Social proof. The group chat, the podcast, the Reddit thread, the coworker mentioning returns, all of it creates the impression of consensus that substitutes for analysis. Loss aversion run backward. The desire to recover losses by staying in a position that is falling, because exiting means accepting a loss that holding keeps theoretical. You knew these terms. You had read about them. Reading about cognitive biases does not make you immune to them, any more than reading about gravity makes you immune to falling. The knowledge is theoretical until the money is real and the screen is red, and the group chat is talking about accumulating more at the dip. What was not built? In 2020, when you moved $6,000 into the brokerage account, the S&P 500 was at $2,800. If that $6,000 had gone into a total market index fund and remained there, it would be $13,400 today. Every subsequent amount you moved into speculative positions carried a similar opportunity cost. The $41,000 total that passed through the brokerage account in pursuit of faster returns, invested in a simple index fund at the point of each deposit, would be $67,000 today. You have $3,100. The gap between $3,100 and $67,000 is $63,900. That is not the worst loss in this story. The worst loss is the compounding that did not start. The retirement account that stayed at the minimum while the disposable capital chased returns in a brokerage account that produced the opposite. The 7 years between 30 and 37, when the income was adequate and the intention was present and the execution was directed entirely toward the wrong instruments. What the hot investment always is. It is always the thing that has already gone up. This is the mechanism that makes it visible, that puts it in the group chat and on the podcast and in the article that surfaces on the third day of hearing about it. By the time it reaches you, the people who understood it earliest have already built their positions. By the time it reaches the group chat, you are providing liquidity for their exit. This is not cynicism. It is the structure of how information travels and how asset prices respond to information. The thing that has gone up because people who understood it bought it. The visibility of its rise is what attracts the next wave. The next wave funds the returns of the first wave. This is not always true of individual securities. It is reliably true of speculative assets at peak cultural attention. What changes at 37? Not the brokerage account, which stays open, which you do not close out of sentiment for the version of yourself that opened it with different expectations. What changes is what the account holds. The $3,100 moves into a total market index fund. The contribution that used to fund speculative positions moves into the 401k at maximum. The group chat mutes, not from bitterness, from irrelevance. The chat was a noise machine. You needed the noise to feel like participation. You no longer need to feel like participation. You need the account to grow, slowly, without announcement, in the background of a life that has stopped organizing itself around the next thing that is going up. The index fund has a 0.03% expense ratio. It does nothing interesting. It returns the market, which across long periods is enough, which was always enough, which you now understand not theoretically, but through the specific education of having spent 7 years and $63,900 learning what enough actually means. The group chat still exists. Someone mentioned something last Tuesday. You did not open it. Subscribe so you don't miss the next one.